Welcome to Iron Financial. This is where we help you forge a stronger portfolio. I'm your lead analyst. Today we are getting our hands dirty. We are tearing down and rebuilding the entire investment case for Weibo, that's ticker WB. The company just dropped an earnings report that has completely fractured the market, splitting it right down the middle. It's ignited a firestorm, really, between the bulls who are screaming deep value and the bears who are convinced this company is in deep, deep trouble. So the question is this a golden opportunity that Wall Street is just too spooked to touch, or is it a dangerous value trap just waiting to spring on unsuspecting investors? Let's hammer out the facts and find out.
So first things first, let's look at the immediate fallout. The market, well, it delivered its verdict, and it did so without any hesitation. It was swift, and it was absolutely brutal. The stock got pummeled, dropping a full 6% right after the announcement. Now, you have to understand, this wasn't some gentle, orderly pullback. This was a clear, unmistakable vote of no confidence from investors. Wall Street took a single look at these numbers and sprinted for the exits. That kind of violent, panicked reaction is a massive red flag. It tells you there's a serious conflict, a deep contradiction buried inside the company's report. Our job today is to march right into the heart of that conflict and figure out what is really going on under the hood.
All right, so the market clearly hates it. The price action, the charts, they are all screaming one thing: get out. But the million-dollar question is the market right? I'm the market skeptic, and my job here is to question that exact narrative. You know, whenever I see panic selling on this scale, I have to step back and ask, is the crowd running from a real fire, or are they just choking on a little bit of smoke? Are we looking at a truly solid steel investment that's being sold off for scrap prices simply because of a short-term knee-jerk panic? Or is this just a classic rust bucket trap that's finally showing the deep corrosion that's been eating away at its foundation for years?
Okay, let's get right into the numbers, the very data that sparked all this chaos. Weibo's latest report, frankly, is a perfect storm of conflicting signals. It's why everyone is so confused. On one hand, you have revenue that actually beat expectations, which 9 times out of 10 should be a clear positive, a reason to celebrate. But on the other hand, their profitability, the bottom line, their earnings per share, that missed, and it missed by a pretty wide margin. This right here, this is the core of the confusion. It's the reason the bulls and the bears can stare at the exact same financial report and come away with two completely, wildly different conclusions. So let's bring some clarity to this mess.
Now, you have to look closely at this slide because the sheer disconnect it shows is, well, it's pretty staggering. On the right, you see Q4 revenue hitting $473.3 million. That's a beat on Wall Street estimates. You have to put that in context. In a very tough macro environment, especially for advertising-driven companies in China, bringing in more money than the experts predicted is a real sign of strength. It says your top line is resilient. But then your eyes drift over to the left and the entire picture just crumbles. Non-GAAP earnings per share came in at just 25 cents. The consensus, what everyone was expecting, was 33 cents. And let's be crystal clear about non-GAAP. That's the company's preferred way of showing its results. They strip out certain one-time costs to present a cleaner picture of their core operations. So even by their own friendlier metric, they fell flat on their face. The crucial takeaway is this: they are successfully bringing in more business, but they are becoming significantly less profitable on that business. That is a classic textbook recipe for investor panic.
Right. And in the middle of all this chaos, you have a revenue beat, you have a massive earnings miss, you have the stock getting absolutely crushed. The CEO, Gaofei Wang, he comes out and has the audacity to call it a solid performance. You have to ask, solid for who? It certainly wasn't solid for the shareholders who just watched a big chunk of their investment evaporate overnight. This is exactly the kind of executive language, that corporate speak, that sets off all the alarm bells for me. It forces us to ask a really tough question. Is this genuine confidence from a leader who truly sees an underlying strength that the market is just completely missing, or is this just desperate damage control? We need to dig much, much deeper than a simple press release.
All right, enough of the initial market reaction. It's time to silence all that noise and do the heavy lifting ourselves. Right now, we are going to build the bull case from the ground up, forging this argument piece by solid piece. We're going to focus exclusively on the hard, cold data that suggests Weibo isn't just cheap, it's a deeply, fundamentally undervalued asset. Let's start constructing this fortress of value, and then we can properly test its foundations.
The first pillar, and you could argue it's the most compelling one for income-focused investors, is this number right here, a 6.3% forward dividend yield. To really put that into perspective for you, that is more than 4 times what you'd currently get from the S&P 500 average. In an environment today where yield is so scarce and hard to find, this represents a massive cash return being paid directly into the pockets of shareholders just for holding the stock. And what makes it even more potent is that this yield is sitting near a 1-year high, which is a direct result of the stock price falling so much.
So for a new investor coming in today, this means the income proposition has literally never been more attractive. The bulls will argue that this pays you, and pays you handsomely, to wait for a turnaround.
Now for the second pillar of this fortress, pure, unadulterated value. And this slide just illustrates it perfectly. A price-to-earnings ratio of 5.49. Now let me be perfectly clear, this isn't just low, this is in the absolute bargain basement of the market. The average PE for a tech company can easily be 25, 30, sometimes even higher. Weibo is trading at a tiny fraction of that. In fact, for Weibo itself, this PE ratio is hovering near a 10-year low. This metric is practically screaming that the market has almost zero faith in its future earnings power. And for a value investor, that presents a potential opportunity to buy those future earnings for just pennies on the dollar.
And if the ridiculously low earnings multiple wasn't enough for you, let's look at the company's actual assets. A price-to-book ratio of 0.68. So what does this actually mean in plain English? It means the stock market is valuing the entire company at just 68% of its stated net asset value. You are literally, and I mean literally, buying the shares for less than the theoretical liquidation value of the company's assets minus all its liabilities. It's a classic deep value metric that a guy like Benjamin Graham would have absolutely loved. It suggests that even if the company's earnings power is impaired for a while, the underlying assets on the balance sheet provide a significant, tangible margin of safety.
And now we get to the bedrock, the absolute foundation on which this entire bull case is built. And that foundation, it appears to be forged from solid steel. Weibo is sitting on a war chest of $2.4 billion in cash and short-term investments. Now get this, at the time of this report, the company's entire market capitalization, the value of all its stock was roughly $2.39 billion. Think about that for a second. Their cash position alone is essentially equal to the value of the entire company. This is an incredible financial backstop. It virtually eliminates any near-term bankruptcy risk and gives management immense flexibility to weather any storm, to reinvest in the business, or to return even more capital to shareholders.
So what about the bigger picture? If we zoom out from all the noise of one bad quarter and we look at the full fiscal year of 2025, the bull case honestly gets even stronger. Let's look at the GAAP net income. Now, remember, GAAP stands for Generally Accepted Accounting Principles. This is the official by-the-book number, no funny business. It wasn't just positive, it jumped to $449 million. That is a massive increase from $300 million the year before. And that strength flowed directly to the bottom line, with diluted EPS jumping from $1.16 to $1.70. All of this while servicing a colossal user base of 567 million monthly active users. The bulls will argue, and pretty convincingly, that this annual performance demonstrates real, underlying profitability and growth, and that's far more important than a single-week quarter.
Okay, I have to admit, that is a powerful, compelling argument. A fortress built on deep value metrics, a huge dividend, and an absolute mountain of cash. It looks almost impenetrable when you just look at the surface. But here at Iron Financial, we don't just admire the architecture of an investment, we take a sledgehammer to it. So now it's my turn to stress test this entire structure. It is time to find the cracks in the armor and to see if this foundation is truly as solid as it seems or if it's all just a pretty facade.
And the first crack we find, well, it's not a crack, it's a gaping canyon. As you can see so clearly on this chart, the company's non-GAAP operating margin, its core profitability, it absolutely collapsed. It plummeted from a very healthy 30% in the fourth quarter of last year all the way down to just 21% this year. That is a 900 basis point drop. Let me put that in context. In the world of finance, that's not a minor adjustment, that is a 5-alarm fire. And what was the cause? Costs and expenses surged 13% year over year. This tells me they don't have a growth problem, they have a spending problem. Their entire business model is getting less efficient and it's happening fast. And what's the direct, painful result of that margin collapse? This slide right here tells the whole ugly story. Weibo swung from a net income of nearly $9 million in the fourth quarter of 2024 to a net loss of $4.7 million in Q4 2025. Let me repeat that because it is absolutely critical. Their revenues went up, but they still went from making money to losing money on an official GAAP basis. That is the very definition of a deteriorating business. This isn't some problem they need to worry about in the future. Their profitability is eroding right now, today, and it's a massive red flag that you simply cannot afford to ignore.
Accounting profits, they can be manipulated, but cash is king. So let's follow the money. This timeline shows the cash from operations for the full fiscal year. In 2024, Weibo's core business generated almost $640 million in cold hard cash. Then, in 2025, that number fell off a cliff, dropping all the way to $519 million. That is a 19% year-over-year decline. The machine, the engine that actually generates the cash to pay the bills, to invest for the future, and to pay that beloved dividend the bulls love so much, it is slowing down dramatically. That huge cash pile that looks so safe isn't being replenished anywhere near as quickly as it once was.
Now it's time to bring out the heavy equipment. This kind of stress test requires a tool that was designed for one specific purpose: to predict financial distress. This number you see on the screen, 1.47, is Weibo's Altman Z-Score. And please, don't mistake this for some obscure new age metric. This is a time-tested, academically validated formula that has been used for decades by serious analysts to gauge a company's proximity to insolvency.
Let's be very precise about what this actually means. The Altman Z-Score was specifically developed to predict the probability of a company going bankrupt within 2 years. As this slide shows, any score that falls below 1.8 puts a company squarely in what's called the distress zone. Weibo's score is 1.47. So while the bulls are staring at that $2.4 billion cash pile and feeling safe and secure, this trusted, objective model is flashing a bright red warning light about the company's overall financial health. It's looking past the cash, and it's seeing serious signs of decay in working capital and profitability. This isn't just a crack. This is a seismic warning of potential structural failure ahead.
Okay, that is a devastating bear case. You've got collapsing margins, a swing to a net loss, falling cash flow, and a financial distress signal from the Altman Z-Score. But we have to circle back to the cornerstone of the entire bull argument, that huge 6.3% dividend yield. The bulls will tell you this generous payout is the ultimate trump card, that it compensates investors for any and all of the risks we just talked about. We need to put that dividend on the scales and see what it's really, truly worth.
But hold on a second. That high yield is a mirage. You have to understand, a 6.3% yield is just a mathematical function of a collapsing stock price. It's not a sign of strength. Let's look at what actually matters: the real, hard cash the company is committing to its shareholders. For fiscal year 2024, Weibo's board announced a total dividend payout of $200 million. Now look at the payout for fiscal year 2025, the one they just announced with their so-called solid performance. They slashed it to $150 million. That's a $50 million cut, a 25% reduction in the actual cash being returned to the owners of the business.
So yes, the yield looks great today if you just look at the percentage. But a cut is a cut, and actions always speak louder than press releases. A healthy company that's operating from a position of real strength does not cut its dividend by 25%. It just doesn't happen. This action directly contradicts the solid performance narrative that came straight from the CEO. It signals one of two deeply troubling things. Either the board has no confidence in the company's ability to generate sufficient cash in the future, or there's a pressing, urgent need to preserve cash right now because of all those operational fires we've already identified. So, which is it? Frankly, either answer completely demolishes the entire dividend-based bull thesis. All right, the evidence is all on the table. We've constructed the bull's fortress of value brick by brick, and we've taken a sledgehammer to the bear's crumbling foundation. We've seen the powerful, compelling arguments from both sides, and they're all backed by the hard numbers right from the source. So now it's time to step back, to weigh it all, and to deliver the final, actionable, iron verdict.
So let's weigh this one last time, side by side. On the bull side, you have a fortress built on undeniably compelling value. You have objectively deep value metrics with a P/E ratio near a 10-year low and a price to book well below 1. You have that eye-popping 6.3% dividend yield, and it's all supported by that massive $2.4 billion cash pile, not to mention a very profitable full year 2025 in the rearview mirror. But then you look at the bear case, and it reveals a foundation that is actively crumbling right before our eyes. You have a catastrophic margin collapse in the most recent, most relevant quarter. You have a 25% cut to the total dividend payout, an undeniable signal of weakness from the board. You have operating cash flow falling 19% for the year. And then, looming over everything is that Altman Z-Score of 1.47, screaming financial distress.
So, what is the final iron verdict? This is not a simple buy or sell. Weibo is the textbook definition of a value trap or potentially a career-making value opportunity. It is a classic value play that presents with significant, undeniable structural cracks.
The potential for high reward here is inextricably welded to an extremely high level of risk. The numbers show both immense balance sheet strength and terrifying operational decay happening at the exact same time. This is an investment only for those with nerves of steel and a very deep understanding of all the risks involved.
And this brings us to the final crucial question that you, the investor, must answer for yourself. With a stock that carries this many red flags right alongside its high yield, are you truly being paid to wait for a potential turnaround? Or are you simply paying for the privilege of taking on the enormous risk of holding a rapidly deteriorating asset? Here at Iron Financial, our mission is to arm you with the right questions and the hard data, never easy answers. It's your capital on the line. Make sure your portfolio is forged from strength.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.